Hi everyone, my name's Darryl Panes, CEO at As Good as Gold Australia, and today once again I'm joined by my brother Brian and partner at As Good as Gold. And today we interview John Adams, Chief Economist at As Good as Gold Australia. Good afternoon, John.
Good afternoon. How are you going?
Very well, thank you. Gorgeous day down here in Adelaide. Best part of the world.
And it's slightly overcast here in Parramatta, but it hasn't started raining yet, so it should be all right.
um, just before we start on today's topic, John, I'd like to confirm that you will be speaking for As Good as Gold Australia at two major events early in the new year. Firstly in Melbourne, of course, at the GFC 2.0, the Next Big Drop conference. And that'll be on Saturday the 2nd of March, and then in Sydney on Saturday 16th of March. So for more information on this, our viewers could head to the link below this video to book your tickets. It'll be a great event. Having said that, John, you have just completed a very thought-provoking editorial titled, "Can Physical Silver Change Your Life?" Let's explore that subject in a little more detail. Some people are saying that silver in particular has the potential to surge significantly and maybe even emulate the likes of the Bitcoin rush 2011 through to 2017. Noted experts of the caliber of Jim Rickards, Michael Pinto, Egon von Greyerz are talking gold at 5 to 15,000 US dollars per ounce, silver up to $500 an ounce. These projections are based on a number of factors, of course, and if indeed they came to pass, would certainly be life-changing for many people. John, you've listed 7 factors that investors should consider in assessing the viability of this potential phenomenon. The first factor you have highlighted is the state of the economy, which doesn't surprise. Right now, we're experiencing very fragile markets throughout all markets. Stock market is in disarray. Global debt markets are accelerating to all-time highs. And we've got massive housing bubbles in different parts of the world. Perfect recipe, one would say, for precious metals. So would you expand, if you could, on your first point, the economy? So if you could talk us through that.
Sure. So I mean, just to take a step back. So it's obviously in terms of the article. So obviously there is a lot of chatter among, the gold bugs, the silver bugs, the whole host of people in the investment community. So I thought it'd be, worthwhile to sort of, summarize their arguments as to why they think that, gold will go up, but in particular what I've written about in terms of silver, obviously the projections are quite high. So obviously on the first point is, so I think there are sort of 2 big factors at play when it comes to the state of the economy. The first one becomes confidence. So obviously, as and as we've stated in previous interviews, we have the biggest debt bubble in Australian history. At the same time, we've got the biggest debt bubble in the history of the world. And basically, when confidence starts to wane and people lose faith in the stock market, the bond market, real estate, etc., and they're looking for a place to put their wealth in a safe asset class, historically for the last 5,000 years, they all go to gold and silver. So obviously, once we start to get into this economic Armageddon scenario that I've been forecasting for the last couple of years, you're going to see more investors starting to move more into gold and silver, and that should obviously be pushing up the price, whether it is of a inflationary nature or a deflationary nature. That rush to gold and silver should actually happen. So that's what's happened in the past, and there is no reason to expect that it won't happen again when people lose confidence. But the other sort of component is that, particularly with the bond market, so the global bond market is multiple times bigger than the share market, obviously multiple times bigger than the gold market and the silver market. So particularly as the Americans continue to raise interest rates, and from all the indications in the last 24 hours, it looks like that the US Federal Reserve will raise interest rates in December. So as those rates go up, that will place more pressure on bonds, and bond prices should come down. So obviously, if people are losing money on bonds, because so there's an inverse relationship between the price of a bond and the interest rate. So as interest rates go up, the bond prices fall. So a whole bunch of people around the world who have got their money in bonds, as the interest rates go up, they're actually losing capital. So there is a view that people will at some point lose confidence in bonds because they're losing money, and then there'll be a big sell-off in the bond market, and then they'll look for another asset class where they can put that money in order to make a profit, and that should lead to a big chunk of money going to gold and silver. And if that were to occur, you would see a rapid rise in the price. So they're basically the two factors that when I talk about the state of the economy, that could be the catalyst for gold and silver to go up significantly.
So it is a safe haven issue, isn't it, really? I mean, and this is a cycle. I mean, this happened 2007-8, it happened 71 through to 1980. So we're seeing it all take place over again. We're watching the block going back, when was it, on a week ago or thereabouts, wasn't it, Brian?
I don't watch it.
Brian doesn't watch it, but I was watching the block. And the reference there was the fact that the housing industry has, I think it's experienced the biggest drop in history in Melbourne, that is in prices, ever. So in that scenario, of course, people are looking for alternatives, and gold and silver are the standout. That's really what you're saying. Not prepared to invest in the stock market, not prepared to invest in the housing industry. That's in a bubble. So what else do you do? Gold and silver become the safe haven. That's really what you're saying.
Yes. Although the only thing I'll say on real estate prices, because it is something that when I do talk to parliamentarians, they talk about the falling price in real estate. So we are seeing, I think the Sydney house prices in the last 12 months has fallen on average of about 7.5%, and in Melbourne is about 5%. But the more important factor is household debt, and household debt hasn't started to fall in Australia, and household debt is still continuing to rise. So even though we're seeing house price falls, the cancer in the economy is not house prices, it is the debt. And the debt, not only in Australia, but around the world, it is continuing to rise. So once that debt becomes problematic from an economic standpoint, that's when you're going to start seeing, real shaking confidence. So I think, for some people, whether they're investors or owner-occupiers, they've got some confidence issues with the real estate market because you're seeing prices come off. But the real big shake in the fundamental faith of the current economic system is going to happen when the current debt load becomes, when it becomes acute, and that hasn't happened yet.
Right. Oh, okay.
You've got 7 points here we're discussing today. I'll be talking about this one's point 2. So the subject matter of point 2 is the silver spot price versus the mining costs. I'm just going to add a couple of things here and then, up for discussion. Rick Rule is a gentleman that I listen to quite often. He comes from Sprott Management, and he says the cure for low prices is low prices. And that sort of makes sense, because once you get low prices, it can only go higher, not lower. So that's what his statement is. Reference to mining costs and things like that, all-in sustaining costs. It's a phrase that is quite often heard. All-in sustaining costs means all costs referring to the cost of silver. Takes 10 years to develop a silver mine, so that's got to be looked at as price of silver. And it is interesting that over the last 30 years, the price of silver has reached $50 twice, US dollars, $50 twice. So can you put your comments on this?
Sure. So when it comes to commodity cycles, what tends to happen is that when the mining industry in general or a particular commodity gets out of favor, the price will fall to a level that it's uneconomic to mine. So that's when the price is lower than the cost of actually mining the actual commodity. So that is actually a telltale sign that that basically you've hit a bottom in the price of that commodity or metal. And that's basically a signal that you've hit the bottom. You should be investing at that point, and that you will start to see a whole host of mining companies doing a number of things in that period, things like reducing production because it's uneconomic to mine. They can't actually make a profit. You start to see a whole bunch of mining companies get into financial difficulty, and you may see some consolidation over those companies. But also you'll see a stop in future exploration. So that is what happens when sort of all-in sustaining costs become lower than the price. Now, when it comes to silver, and I think in your recent interview with Keith Neumeyer, with First Majestic Silver, I mean, according to Keith, his biggest mine that he just acquired, the cost of that is above the current spot price. So the current spot price in US dollars is about $14.50 per ounce, and the cost of producing an ounce of silver out of that mine is higher. And there's a whole host of silver mines across the country sorry, not around the country, but around the world, that the costs are higher than the current price, so it's uneconomic. But having said that, obviously Keith said that there were a couple of smaller mines where he can still make some money. So obviously, now some people think that the silver price may go a little bit lower from where it is today. Some people think we've hit the bottom, but obviously, for a whole host of mining companies, you're starting to see, people winding back on production. I mean, obviously, there's little exploration activity happening at the moment. And obviously, even in terms of what Keith Neumeyer was saying, he's looking at his biggest mine to reduce the level of staffing and the level of cost because because it's uneconomic at the moment. So obviously, we're seeing this in silver. We're seeing this in a few other sort of commodity areas as well, and it's a telltale sign that the price is too low, and you're going to see a shortage of supply, and that obviously will lead to the commodity cycle turning around, and then the price should start to go up.
Yeah, I agree with all of that. It is interesting that I think the average person, the person on the street, he doesn't see mining. He doesn't see mining as a different industry. But as I see it, mining is one of those things where after digging out all the ounces of ore, you've got to replace them with new ore. Otherwise, you haven't got a business. So if you've only got 1 year's supply, you've got to start looking for more, and that looking for the ore costs money. So that's where the all-in sustaining costs really come in.
Yeah.
Okay, Darryl, I think you've got the next question.
Well, you've made reference here, point 3, to a tightening physical silver market, John. Now, we know that's occurring, but fill me in if you could. The demand for silver over the last few years, 2 or 3 years, has been relatively low. But there has been a movement. But this seems to have caught out a number of the miners. And we spoke with Keith Neumeyer about this the other day. So can you expand a little bit on this tightening physical silver market that you've made reference to?
Sure. So a lot of silver experts, whether it's Keith Neumeyer or David Morgan, I mean, they do a lot of their analysis based on the statistics coming from the Silver Institute, which is, that is based in Washington, D.C. So having a look at their annual figures, you're clearly seeing that total silver supply, annual supply, has been falling since 2014. Obviously scrap silver has been falling quite rapidly, and then from about 2015, the mining silver supply has also been falling. So supply has been falling, obviously, over the last few years, and I think that is a reflection of price, because it is for a lot of miners it's uneconomic, and so therefore they've been reducing production. But then obviously on the demand side, so just like what you said, so there was a lot of, particularly in the investment silver side, there was a lot of demand, back in about obviously in 2011, but even in the aftermath of 2011, silver demand was still relatively strong. But you've seen over the last few years a fall in silver demand. And particularly on the investment side, that has really dropped off, particularly in the US. But also, so you've seen the supply fall, demand fall, but still over the last few years, the demand for physical silver is still in excess the supply of physical silver, according to the Silver Institute. So that's basically indicating that the inventories are being used up, and so David Morgan has said that the above ground inventory of silver, it is still relatively large, but every year that is sort of shrinking because they're not producing enough silver to meet demand, and because of that, the inventory, obviously the inventory is getting smaller, and so obviously that is another factor that would indicate that it's going to be tougher to get your hands on physical silver, and that should also be a factor that's leading to the price going up.
Well, it doesn't seem to take much of an increase in demand, as has been the last couple of months. The increase in demand has accelerated, and in particular over the last few weeks, so that everybody I speak to now within the mining fraternity or the mints themselves are telling us that they weren't prepared for this. This is really interesting because I'm only trying to imagine right now what would happen if the demand really started to increase, and we're on a knife edge. So just imagine for a moment, currently, Brian and myself are having the same issues that other precious bullion dealers are having, and that is that we're finding that mints are saying we downsized, we changed our production techniques, we weren't prepared for a new increase in activity. And so they can't produce silver coins, silver bars at anywhere near the rate they need to at the moment. Their production is way down. They've laid people off. They've now got to re-employ people, retrain people. And so right now we're finding that we're waiting a month. We've got some suppliers who won't even take orders. And I mentioned this the other night to Keith. So a serious dilemma at the moment. We have 3 refineries currently that we are employing to produce enough gold bars for us to supply our clients. And in some cases, we've still got lead times of up to a month. So as I said, if the demand just increased, if another 1% of the population decided now is the time to purchase silver, I could see massive supply problems. How do you see it at your end?
No, so I would agree with that, and just going back to the first point that we're talking about, in terms of when the economy starts to wane and confidence is really shaken. I mean that's when you're going to see a massive spike in demand. Obviously much more in terms of multiples compared to the small increase in demand that we've seen over the last sort of couple of months or so. So when that real what they call the dumb money, once the dumb money starts to come into the market, I agree, it's going to be very hard for the refiners to keep up with demand, and there's going to be some shortages, and that's obviously going to cause problems for people who want to get their hands on physical silver bullion to actually get it.
And it's going to be a lot more expensive. Supply demand prevails there. We've had mints that have been in contact with us over the last week or two, and they've all gone for increase their premiums. And they've said, we've just got to do that. It's a supply demand thing. So right now we're seeing 20, 30 cent increases in premiums all around the world. We're talking on an ounce of silver. So you can imagine what might happen if, as I said before, demand really starts to accelerate. Those premiums could go through the roof.
Yeah. So what I think is the important message for the viewers is that at the time of the crisis that I see happening, if you are looking for a safe haven to protect your wealth, you may not be able to get it because of the inability of either the mines or the mints to supply the market with sufficient amount of silver. So that's obviously why you're seeing a whole bunch of silver and gold experts around the world saying, well, don't wait for the crisis, get it while you can, because when you really need it, you probably won't be able to get it.
Yeah, absolutely.
Yeah, very valid points. Your point 4, John, from your editorial is basically headline "More Industrial Applications for Silver," and it was because we interviewed Keith Meyer last week. He brought up a couple of very, very good points. And one was that at VW cars, they're looking at, the company's looking at all electric cars by the year 2030. And if it's interesting to note that electric cars will have 2 to 3 kilos of silver in a car, whereas at the moment it's 1/3 in a normal combustion car. So more applications for silver. I'm sure the industry will be requiring their silver well before the investor does. So your points, what do you believe? What do you think?
Yeah. So when you look at the annual supply of silver, about 60% of that annual supply is required for industrial purposes, and then beyond that, you've got other uses for silver investment, and then obviously a few non-investment purposes. So I think the key point to make here is that when you listen to Keith Neumeyer and a whole bunch of other people, there's obviously existing technologies like smartphones or solar panels or electric cars that are going to require more amounts of silver going forward, but also that there are a few sort of new applications which some people think will come on to the market around the world in various industries in the next 18 months to 2 years, that's actually going to increase the industrial demand for silver. So obviously when we talk about the demand for silver, when I talk about economic Armageddon, I'm basically saying that the investment demand for silver is going to go through the roof. But independent of that, Keith Neumeyer and others in the industry are saying that the industrial demand for silver is going to rise. So obviously with those new applications for silver, that's obviously boding well for once we get into the next commodity cycle. The demand for silver from the industrial side looks like it's very strong. The prospects are very good, and that's obviously going to bode well for prices going higher in the medium term.
Yeah, and to make a point here is it's not just new sources for silver being used. I was only listening to Prime Minister Modi out of India. Now, we know India's got a population of 1 billion people, but interesting enough, half of those have got no electricity in their homes. So he brought up a point that he wants to have electricity in every home in India by year 2025, and he wants it to come from solar energy. So you can actually see the demand just skyrocket over the next 5 to 10 years.
Absolutely. Look, that's really a great example, because when people buy silver bullion and then they're buying for investment purposes, I've had several clients, around the country have asked me about the liquidity issue. So, for example, they've asked me if I buy, say, $50,000 worth of physical silver bullion, and then I want to sell it. Will there be a market for me to sell at the time that I want to sell? The point I've made is that, sure, there'll be, if the price skyrockets, there'll be other investors that will want the silver if you want to sell. But independent of the investment side, industry will want silver wherever they can get it. So if the industries around the world need to go to the investment side of the market and say, hey, you've got kilo upon kilo of physical silver bullion, can I buy it off you because I need to use that silver in industrial applications? Well, that can easily happen. So, for those potential investors who are asking the question, if I put a lot of money in silver today, can I find a buyer when I want to sell? Well, obviously, independent of other investors who may or may not want to buy, there is industry around the world who are keen to get their hands on that silver. So I think on the liquidity issue, and I'm sure you guys can speak to this with the clients you're talking to when they ask about the liquidity of the market. Obviously, if India is going to build a massive amount of solar panels, well, then the international demand for industrial silver is going to be quite high.
Yeah, totally agree. Darryl?
Yes. Okay, gold-silver ratio. You've listed that at 0.5. Currently, gold-silver ratios, it was this morning, 84-1, which is out of sight. And always a very strong indicator, John, that there's something terribly wrong. And it rarely stays at 80-1 for any length of time. So we can expect, historically, it's telling us that those ratios are going to close in and we're going to see a major movement in precious metals once again. All of these indicators are very strong. It's all historical evidence of what's taken place in the past. But here we have another one. 84 to 1 today. If you could provide us your point of view there.
Sure. So it's 84 to 1 today. A couple of weeks ago, it was about 85. So it was about at a 23-year high in terms of the gold to silver ratio. So, just to give an example, I was speaking to a client this morning who was looking at buying some gold, buying some silver, and obviously wanted my views as to, what was the right play. And she wasn't aware of the gold to silver ratio. So obviously, historically, it's only happened a few times where the gold to silver ratio will get above 80. And so we're in that range now. I think there was about 25, 30 years ago, the ratio got up to about 100. So that was the peak that in the last 40 years, it got up to a ratio of about 100. But, what that ratio is basically saying is that, silver relative to gold is very cheap. And that obviously if gold was to go up, historically speaking, you see a collapse in the ratio between the gold to silver ratio. And so in the last few times where silver has skyrocketed, the ratio will go from about 80 to about 30. So that means that even if you may make some money on gold, you will make a higher rate of return on silver. And speaking for myself, that's why largely I've been buying more silver than gold because of that ratio. Now, when silver really spiked in 1980, the ratio fell to 15 to 1, and we're talking Australian dollars using Perth Mint data. So there's all sorts of speculation as to once this spike in silver, particularly when the economic crisis happens, what will that ratio look like? Some people are saying 30 to 1. Some saying, I think David Morgan says maybe 15 to 1. I think keep in mind your previous interview sort of alluded to about 15 to 1. Some people say, even on the extreme end, some people are saying it's going to be 1 to 1. So obviously, we'll wait and see where the ratio lands. But the current ratio of about 84, 85 to 1 is anomaly compared to historical experience, and it's a clear signal that silver relative to gold is basically dirt cheap at the moment.
Yeah, and the reason, of course, that takes place as well is because silver is more affordable. By purchasing an ounce of gold today at say $1,800 versus purchasing a 1 ounce of silver coin at $25. It's more affordable for most people to be able to do that, let alone purchasing $10,000 worth of gold. You might 5 ounces, 6 ounces. You can buy a lot of silver for $10,000. So there is this massive rush into purchasing silver, and of course the ratio closes in. The problem is that this time the silver probably just isn't going to be there. The demand on it industrial is that massive, so that's going to force the price up again, and it's probably the reason why there are some people who are suggesting that the parity, silver to gold, could be parity. Seems alarming, but under the current set of circumstances, it may actually lead to that.
Yep. So look, I definitely think we're going to see the ratio narrow. How much will narrow? I think we'll time will tell.
Sure. Brian?
Yeah, so we're coming up to point 6, so we're getting closer to the end, but there's still a lot of information coming our way, or coming your way as well. Point 6, you make a comment, net long commercial futures silver position. So we're talking about on the COMEX, the pricing on the COMEX. Now you can never talk about silver and the pricing without the subject of JP Morgan coming in. They seem to have a pretty good position on the subject of silver. But I read an article, and I think you know about it, from Zero Hedge. The story broke last week. It may have been the beginning of this week. But JP Morgan, the story is that JP Morgan, an employee, John Adams, pleaded guilty to conspiring with other traders to manipulate the price of silver between the years 2009 and 2015. Sentencing date is December the 19th. Now, you got that point. You've also got Ted Butler's position with he thinks that JP Morgan have got somewhere between 150 million and 750 million ounces of silver. Where is all this heading, John?
Sure. So the point six that I sort of made was, so obviously with the COMEX every Friday you get the commitment of traders report, and so the commercial category, which includes JP Morgan, but includes the miners, the producers, the users of the silver, they historically have been net short. So and obviously when you interviewed Keith Neumeyer a couple of weeks ago, he spoke about there are rig rules around how many long contracts you can have and how many short contracts you can have. So a long contract is basically an intention to buy silver, and a short contract is an intention to sell. So obviously, you've had JP Morgan and the producers and the users in the commercials category of this report have a net short position, basically saying that their net position is that they were intending to sell their silver rather than buy. But obviously a few weeks ago, that turned around for the first time in a quarter of a century, and they went net long for a couple of weeks, but now they've gone net short. So I think that the key thing is that if the producers and the miners, but also if the bullion banks, if they have a net long position, now it was net long for a little bit. Let's see if they go back net long now. But as we speak, it's a relatively small net short position compared to historical averages. But it's a signal that if JP Morgan is expecting the price to go up, and they've positioned themselves in the COMEX and the LBMA to have a net long position, it's a signal that people holding silver or producing silver expect the price to go up. So I think the net long position, even though it was a few weeks short-lived, it's a signal that that the key players in the market are expecting the price to go up, because the flip side to the commercials, to the commercial category, is the technicals, and the technical traders historically have got the call wrong between the price going up and the price going down. So so they typically are net long for a little bit. They were net short. So it seems to me that the net long position was a significant signal that the price could be going up shortly.
Yes, it's all very interesting, and I think long term it certainly will work its way through into the real price of silver. We're going to go to the next point, which is point 7, and you've titled it the breaking of the paper silver market, which is a continuation of what we've been talking about. But what I did notice at the bottom of your editorial, you have a couple of links, very good links. I would suggest that any person watching this video also goes and have a look at these links. One comes from the states from SRS Rocco report from their website. And I'm just going to read out a couple of little points of interest that comes from the link, and then you can obviously make comments. Physical investment gold to paper gold trading. It's all very interesting that we talk about the spot price is determined on the COMEX, but it's determined by the paper contracts, which we've just been talking about. But the physical investment gold to paper gold trading is presently 233 to 1, which is a phenomenal figure. You would think that could never be beaten, but the physical investment in silver to paper, silver being traded, is 517 to 1. Interesting, in 2016 there was 886 million ounces of silver mined, but there was 180 times that figure traded on the world exchanges. What do you make about all of this?
Sure. So there's a lot of people in the industry, but also like among international investors who are saying that because there's a mismatch, like you just said, between the amount of physical silver being traded, whether it's industry or among investors, relative to how much paper contracts are being traded on these exchanges. And basically, I think the JP Morgan case you raised earlier is actually quite significant. So we have a confession from a former employee of one of the big players in the market that people involved in the paper trading have been artificially suppressing the price. So obviously we have a confession, and that confession said that not only was he doing it, other people at JP Morgan were doing it. His managers knew about it. The managers actually trained him on how to manipulate the price. So now obviously I think the court case next month is going to be quite significant in terms of Does he get a big sentence? Does he get let off? Does he try to dob on other people at JP Morgan or some of the other people in the industry? So obviously, when people, because the price has been manipulated so low compared to where the real physical market is, in economic terms, when you have a price ceiling that is lower than where the equilibrium is, you start to get shortages. And so those people, whether it's in the gold market like Egon von Grey out of Switzerland or in the silver market, like a Bill Murphy, what they're basically alluding to is that because the price is so low, people are going to hoard massive amounts of silver. And this is where Ted Butler says that JP Morgan has accumulated about 750 million ounces of silver because the price is so low and they can do it very cheaply. Once you start to see shortages in the physical market, that's obviously going to undermine the paper market, and then you're going to start to see the price of physical silver go up. So whether it's like what Darryl was saying before about premiums being added on because it's hard to actually get, or with these paper contracts, if the people who are holding the long contracts, if they basically say, well, I've got this contract and I know I want to buy and I expect you to deliver. Well, if you've got multiple times of sell contracts compared to the amount of silver you actually have to hold, well, those who are required legally to deliver the silver will have to scramble and try to get silver any way they can, so that they can meet their contractual obligations. Now, in 2011, and several people have sort of documented this, when the price went from $40 to $50, all that $10 increase was people scrambling to get their hands on physical silver to meet their contractual obligations. Even Yvonne von Grey said in the last fortnight that there are people looking at this paper contract, these exchanges, and basically says that it's actually causing massive problems in the physical market because we're not seeing the genuine price of what it should be. That's going to lead to shortages, and then when these paper contracts break down, that's when the paper market breaks, and then the price will revert back to what the price of the physical market should be, and that is multiple times higher than what we are. So that's the theory of the paper market breaking. Now, obviously, there's been a whole host of characters for the last 15, 20 years who have been saying that this physical market is going to break. But, particularly in the gold market, we're seeing record levels of demand out of China, out of Russia, out of, Iran, Turkey, etc. for gold. The more that they buy gold, that means it's going to be obviously harder to supply gold going forward. So obviously, that's going to cause all sorts of problems who have, for these traders who have these, sell short contracts, which is basically an obligation to sell gold or silver. So when those contracts become acute and people are struggling to actually meet their contractual obligations, that's what people view as breaking the paper market, and then the price will go back to its physical domain. There are estimates of, I'll give an example. Lynette Zhang from ITM Trading calculates that an ounce of gold is in the range of $9,000 an ounce, and an ounce of silver is about $600 an ounce in US dollars, and that's what the physical price should be. But obviously, we will see what happens with these paper markets. But obviously, this court case this sentencing that's happening next month, it's going to be significant to see what are the ramifications for paper trading moving forward into 2019.
Yeah, there's no doubt as we get closer to the court case and all these other stories come out about the manipulation, obviously the price of silver and gold is going to jump very, very high. And obviously silver being the lesser cost metal, more people will obviously jump into the price of silver. What I've recognised, and maybe your comments, you can make a comment here, what I've recognised is that it seems as though everybody makes the mistake of valuing silver and gold in fiat currency. And what I mean by that, And you know through your economics how when you're talking about economically, we have inflation rates of massive in Venezuela and Turkey and Argentina. But I put down a few notes the other day, and Venezuela, which is coming up to 1,000,000% inflation rate. But over there, a 1 ounce silver coin or 1 ounce of silver will buy 3 months worth of food. It's not a matter of whether it's worth $14.50 an ounce in US dollars. It's a matter of what, in desperate times, what will 1 ounce of silver buy you? And I went back and, in 1913 when the Federal Reserve came about, we still had gold, silver backing our currency back then. 1 ounce of silver bought a week's worth of groceries in the US. But today, 1 ounce of silver wouldn't buy you hardly anything. It's cheap. It's what I call cheap as chips. But as I see it, 1 ounce of silver will have to rise to at least $250 an ounce, because that's what it costs to buy a week's worth of groceries. Do you agree with me?
Yeah. No, I think it's like I mean, look, that I think that is a prudent way to sort of think about what gold and silver should be. So it is what you can exchange. I mean, because historically gold and silver has been money, in and of itself. I think it's an appropriate way to think about, well, if I have an ounce of gold, if I have an ounce of silver, what can I exchange in a marketplace for real goods and services, in terms of to determining its value. So I mean, the previous interview you did with Keith about how you could have bought a standard 3 or 4 bedroom house in 1980 with about 800 to 900 ounces of silver, that would be worth about $400,000 today. I mean, I thought that was a really smart analogy. So obviously, for people, anyone thinking about, how they can sort of use their gold and silver in the future. Well, I mean, if 800 to 900 ounces of silver was able to buy a standard house in Adelaide back in 1980, well, I mean, if silver and gold revert back to what the physical market should say the price is, well, people should, if they've got that volume of silver in particular, that should be sufficient for them to go buy, a reasonable property. I mean, look, so I think it's definitely a smart way to think about gold and silver, so obviously, given, so historically, people, when they talk about gold and silver manipulation, they were sort of shouted down as conspiracy theories. Well, we now have someone on the record admitting that the conspiracy is actually real, and that the rigging has been happening. So if independent of the other factors we've talked about, whether it's about the physical market or whether it's about the state of the economy, I mean, if the rigging was to stop, then obviously, the price of silver, the price of gold would go to a level where, whether you could buy a week's worth of groceries with an ounce of silver, or whether you could, buy a house with about 800 to 900 ounces of silver. I mean, look, one would hope that those sort of valuations, would sort of, would come back into the monetary system.
Yeah, well, that was the reality back in 1913. I see no difference being the reality of today. It's not a matter of using a 1 ounce coin to buy your groceries, but that the value is what you get from 1 ounce of silver. That's what the reality is. Darryl, do you want to do?
I think John stated a pretty good case for considering silver as an investment. I would like to share a story with all of our viewers, and yourself, John, because I don't believe you've heard this story before, but and then ask you for your final comments. I want to take you back to 1969. This is a true story. I want to take you back to 1969, where a young man had completed 2 years of his apprenticeship as a fitter and turner. He'd managed to save in that 2-year period something like $2,200, which is a fairly serious savings approach that he had at that point of time to do that. So he decided he wanted to invest his savings somewhere. Spoke to his parents and they couldn't provide him with any real good information. So he decided to purchase some forestry. So it was a couple of acres of forest. This was pine forest. And there was a 30-year maturity from seedlings to the maturity of the plant. And so it was a very long-term investment. At around about the 12th, 13th year, a couple of fires ravaged the area, and it reduced the amount of trees that he had on this acreage quite considerably. At the end of the 30-year period, this young man had received a return of $2,300 on his initial $2,000 investment. So one would say that was a pretty poor investment. But interestingly enough, if we go back again and consider that in 1971, President Nixon took America off the gold standard. If that young man had invested his $2,200 into silver at the time, say we're talking 1969, then he would have seen growth as it was at 46 times. Silver went from $1.20 an ounce up to $50 an ounce. Gold did pretty well too. It went up 24 times from something like $35 to $800 an ounce. So this young man would have been in a position where he could have, in 1980, purchased 2 median properties freehold. He could have placed himself in that position, and I think about this young fellow, I think, what a contrast in those two investments. Very fine line. The important thing was he knew nothing about cycles. He never fully understood at that point of time that the economy revolves around cycles. Real estate can be terrific one moment. The bond market can be fantastic for you at another stage. Stock market, we go through wonderful phases. Right now, Robert Kiyosaki tells us that silver is in the cycle. This is the silver cycle. Robert says silver is the best investment in the world today. Now, I know this story is true because the young man that I am talking about was me. So it's a fine line, John, but fortunately for me, I'm a quick learner. And I took advantage of the second move, and that was from the early 2000s up to 2011, and it worked. This time I wasn't going to miss out. And right now I'm not going to miss out on the third move, which is starting to take place now. This is the time, of course, as I read it, to purchase silver and take advantage of the huge surge that we expect to see ahead of us. So I thought I would share that with you and our viewers. John, any final thoughts? I love your comments. It's been intriguing, and it's been, as I said, you've provided us with a pretty good case for considering silver as a ongoing investment. Any final thoughts?
Sure. Well, I mean, so obviously, I think the first thing is that we'll be publishing the article itself on the As Good as Gold website. So separate to this interview, for those who are interested to read the article, I'd encourage people to go onto the website and have a read. So obviously, we're not the only people in the industry putting these cases forward for silver. There's a whole host of very smart people making very similar cases. So I think people should consider the arguments, that they should do their homework, and obviously if they are convinced with us, because I think it's important to note that obviously you guys have got some of your family's wealth in silver. I've got my family's wealth in silver. So we're not just making this case for the sake of making this case, but we've put our money on the table because we actually believe the thesis.
Correct. Absolutely.
So because we actually believe it, we've put our money on the table for it. Obviously if people think that we're on the right track, and then obviously want to be a part of the wave that's coming on silver, they should obviously give As Good as Gold a call, and obviously talk to us, and ask us further questions, put an order in, and obviously be in position to protect themselves when this sort of economic Armageddon comes, particularly as other asset classes, whether it's property, shares, bonds, etc., are likely to see significant falls.
Thank you for that, John. Thank you. At this point, John, I'd like to say thank you so much for your input today. Very much appreciated as always. Let's keep in mind that John will be our keynote speaker at the Melbourne and Sydney events in the new year, and the details are below. To our viewers and subscribers, this is Darryl Brian Panes from As Good as Gold Australia. Thank you for your valued support. Stay focused, and we'll see you next time. Goodbye for now. Thanks again, John.
Goodbye, John.
Thank you. See ya.